Hey everyone, welcome back to the Essentials channel. So we are in a period of launchless gap. So as we are waiting for new launches to emerge in the Singapore market today, I'm going to be actually dissecting the news that has been currently happening in the Singapore market. Because by understanding the news, you'll be able to forecast Singapore's future market. But not only that, we will also be able to overcome a lot of the market barriers that we personally create for ourselves as consumers. I'm sure by now you have seen the news regarding our population hitting the highest number at 6.11 million by now, as well as our GDP would double up by 2040. So what are going to be the impact of these news, and how can we make sense of that so that you can draw a sound conclusion for yourself as a consumer? Remember to like, share and subscribe if you like our content so far. It keeps me motivated to continue creating high quality, insightful content, as well as it helps with the YouTube algorithm. As always, like what I say, I'm really grateful to all the consumers out there who have reached out to me. Just this week itself, 4 consumers have actually reached out to me to evaluate their current scenario, but most importantly, chart ahead, given the limited supply, but also because we are heading towards the end of the changing policy of the GFA harmonization. What is an advantageous position to take? Should they be entering right now or waiting for the next batch of new launches to come out, which may already factor in higher land costs? So all these things will be taken into consideration when we evaluate your scenario, and I'm truly grateful to be able to meet a lot of my consumers out there and build this community together with you. So today's main focus is also on dissecting property news in Singapore. So the thing is this, we should always learn from our past history and derive the lessons from there. Actually, there is this article that I want to draw our attention to. Is actually this article that was announced by Morgan Stanley. It was published in the Straits Times as well as CNBC in the year of 2017, where the headlines, I believe everybody out there may have remembered this: Singapore's property prices to double by 2030, Morgan Stanley. Alright, so when this news first came out, that time we were actually coming out from a downward trend previously in 2017. It was also the first time where we saw cooling measures happen in 2014, where the government heavily imposed strong cooling measures as the government vision changed from an investment to buying property as a need. So there were many cooling measures that were targeted at multiple property ownership as well as foreign ownership, such as ABSD, such as TDSR, LTV for the first property, second property and third properties. All in all, is for the purpose of making sure that consumers buy property as a need rather than a speculative tool. And back then, with the negative news about our GDP from a downward trend finally recovering, as well as the supply finally balancing out, as well as so on and so forth, they see that property prices were declining for 14 straight quarters. And finally, with that recovery, Morgan Stanley actually made this big claim that they will double up by the year 2030. And actually, on hindsight, if we look back at it right now, we actually realize that what they said is indeed coming true. First of all, the population growth is happening because in the article they actually said property market bears expect slower population growth, an aging population, and a structural growth slowdown to weigh on the long-term property market outlook. However, we disagree and believe home prices will double by 2030. This is a claim that was made by Morgan Stanley, and look what is happening today. It actually translated, and Morgan Stanley's foresight is actually coming true, because when they say property market bear, means it is bearish, it's not bullish. What is dragging it down is our aging population and the lack of population growth that also affects GDP. And we are seeing a totally different scenario today. So the first article that we'll be talking about is actually our population growth hitting 6.11 mil in 2025. The second article that we'll be talking about is the Straits Times actually mentioned that DBS did a research and said that GDP will hit 1.4 trillion by the time we hit 2040. As well as we'll add in a rental yield aspect and dissect the news today, how investors should actually be managing their yield expectation, with a final article. So we'll be going through 3 articles today, the TLDR, as well as certain slides that I create to dissect and analyze the news so that you can draw a better call to action for yourself. So with the Morgan Stanley news that actually lays the precedence of the credibility of news. Sometimes do not ignore this news. In fact, these news can actually be a telltale sign for your future appreciation growth analysis, just like what we see here with the Morgan Stanley news. Alright, so to begin, we'll be starting off with this news article from CNA. Singapore's population hits new high of 6.11 million, increased mainly due to to growth in non-resident population. Actually, don't let this headline fool you. In fact, I've dissected the numbers, which we'll be seeing in a short moment, that actually our citizens grew by quite a fair bit itself. So the TLDR of this new article basically states that, number one, it is a record high population. The Singapore's total population has hit 6.11 million as of June 2025. This represents a 1.2% increase from June 2024 year on year. Number two, non-resident growth is the driver. The non-resident population was the main contributor to this growth, increasing by 2.7% to 1.91 million in June 2025. This increase came mainly from work permit holders, followed by migrant domestic workers. So if you were expecting the EP holders to actually increase, in fact there is a control over it, which we will see in the third article. So there is a reason why I'm choosing these three articles here today, so that you have a clearer idea and call to action of this current market. Alright, next we have citizen and resident status. As of June 2025, there are 4.2 million Singapore residents, including 3.66 million citizens and 0.54 million permanent residents. The citizen population increased by a modest 0.7%. Of course, if you are comparing percentage, then it may look like very little as compared to the foreigners, but we actually should deep dive into the actual numbers, then you will see how it will relate to our real estate demand. Alright, next is of course what is the long-term trend. The annualized population growth was higher than preceding 5 years. This higher rate is partly attributed to the need for work permit holders in the construction sector, supporting infrastructure projects like Changi Terminal and housing supply expansion. So the population growth also helps you to build your houses, you know. Alright, so the last thing is this: in terms of societal context, immigration is vital because it helps moderate the impact of aging and low birth rates. The citizen population continues to age, with 20.7% age 65 and above in June 2025. And then next is of course, based on the government's immigration management, the government granted 22,766 citizenship and 35,264 permanent residents in 2024, maintaining a carefully controlled and measured pace of immigration. Now that is the TLDR. Now let's understand in depth with a little bit of demographics how this would actually affect our real estate market. Of course, to make things easier, naturally they have a diagram to illustrate the breakdown of the population. So here is the breakdown as what we see here based on the slide. And of course, how do we make sense of it in terms of real estate sensing? Alright, so here I actually have an updated slide based on how our supply numbers will tie in together with the population growth. We can see here actually the breakdown of non-residents, PRs as well as citizens. The blue color is the non-residents, which naturally are hit by the 60% ABSD. So I guess we can rule them out in terms of property ownership. There are still foreigners actually purchasing properties, but it's a very, very small percentage because of the tax hit by them. I think they can actually use their capital to do something else better. But unless they are really sincere in investing into Singapore as well as building a base in Singapore, that's exactly what the government wants them to do, which is to keep their resources and capital within Singapore rather than a knee-jerk reaction where if anything happens, they will just pull everything out. You want to be in Singapore, you invest and you stay in Singapore. So I think the people that we should be focusing on is the green color and red color categories. The green color representing the PRs as well as the red color representing the citizens. So previously I actually had a slide that shows the population growth from 2021 to 2023. Back then the population growth grew by about 110k. So if you refer to my previous video before, in the first half of this year, Singaporean citizenship actually grew by 110k based on our previous numbers. PR wise, there's actually not much movement. It used to be 0.49 million in 2021. Today, it went up gradually until 0.54 million over the last 5 years. So meaning to say, the difference between the last 5 years for PRs is about additional of 50,000 new PRs, and for citizens, it's actually a difference of 3.5 versus 3.66 mil in 2025, an additional 160k. So contrary to whatever that the article was stating just now, that it was largely driven by foreigners, actually if you look at the citizenship numbers, actually they have gone up by quite a fair bit. But if we just use percentage to count that time, it may not seem that significant, but if we look at the actual numbers, it actually is quite significant, because in a way, in total, our PRs and citizens grew by about 210k over the last 5 years, which is very significant, you know, if you put it that way. So how to actually make sense of these numbers? So here we see a higher number of citizens and PRs which are in PMETs raised from 62% to 64%. This also means higher purchasing power. And we also see the population growth in general grow from 5.453 million from 2021 after COVID to 2025 at 6.11 million, a more than 500k to 600k of population growth. Note, citizen grew another 50k between 2023 to 2025 as compared to the previous growth of 110k between 2021 to 2023. So that's why I say there is a movement in terms of of citizens. Now, how are we going to make sense of these numbers? I think we are no stranger to this news as what we have mentioned before about Singapore trying to hit 6.9 million by the year 2030. I think that is a little bit too far-fetched, and I'm also a little bit concerned whether our infrastructure is able to withstand such a huge population growth. But I think we all have to agree based on the TLDR of the news just now that we do need new immigration to keep the country progressing forward, as well as to keep up with the aging population, and we need more skill sets coming into Singapore. Whether Singaporeans like it or not, I think it is more about the Singapore policy that always plays Singaporeans first, and I think the government is doing a good job balancing that. But I think we also need to agree that we need to keep up with the birth rates, so on and so forth. But that is for another day to talk about and debate about. But let's look at how do we use these numbers to your advantage in terms of real estate today. So we have this separate number here, which is the Singapore average household number, and you would see that the single home ownership numbers are on the rise. In 2021, the average household number is 3.15. In 2023, the average household number is 3.11. In 2024/2025, the average household number is 3.09. This is just a simple illustration that the household size is slowly shrinking, but that also means that there are more single home ownerships coming up as well. So how do we use these numbers and make sense of it? We use the 210k, which is the Singapore citizens and the new PRs, divided by 3.09, it would result in we need 67,961 units just based on this population growth. And with that in mind, the total units completed until 2028 is 44,208 units of private homes being created. The key question to ask is, are we even creating enough homes for this population growth? Now, one may argue that, hey, these people can buy HDB BTOs also what? Why you only talk about private? Actually, if we look at the numbers itself, the PRs themselves, the key question to ask is, can they buy HDB the minute they turn PR? The answer is no. They have to wait 3 years, whether is it for a BTO or for a resale. So with that in mind, these people who has been renting would already feel that maybe I would want to buy. And what do they go for? They will go for probably private housing. Next, the citizens then will probably be the ones that will be able to buy a BTO. You're not wrong, but most of the time you can achieve citizenship within Singapore is also because you have significant enough contribution in terms of your income, and that's why they assess the number of years that you have been staying in Singapore versus your contribution to society in Singapore, and then from there they will assess whether they will grant you that citizenship status. Right? With that in mind, highly likely they would have exceeded the income ceiling of a BTO, right? And with that in mind, then they will probably go and buy private housing as well. Now, then you may argue, but private housing also got resale what? Now here you're talking about new home supply leh. Anyway, the numbers will work out on itself. Let's assume that 67,961 buyers go and buy 67,000 resale units. All of them go and buy resale units. Am I right to say 67,000 units of homeowners will be displaced? These 67,000 homeowners will also need to go and buy something new. So ultimately, I will still need new supply to cater to these displaced homeowners. So whatever it is, I'm not here to fight with you or debate with you about how accurate these numbers are. I just want to show you the ever-growing demand and how can we make sense of an article like this, drawing precedence from previous articles like the Morgan Stanley article that was released in 2017 and materializing and coming to fruition in the year 2025 and beyond. Right, the key thing is this, I want to show you also is the ever-growing demand. If we use based on 2025 population of 6.11 mil to hit 6.5 million in 2030, applying the same formula, we will need 25,000 homes per year until the year 2030. Now, if we really want to achieve our 6.9 mil population by 2030, applying the same formula again, we would then need 51,000 homes to be created per year until the year 2030. The key question to ask is, are we even creating so many homes? And that's why you always hear news, right, in the either in parliamentary debate or within Straits Times itself that the government is here to churn another 20,000+ of units. By the time we hit 2028, our land supply is coming out with a lot more to replenish. It is all to cater to the population growth that continues to drive our economy forward. Alright, so now with the population growth in place already, the next thing is to address the GDP as well as the affordability of homes. Whether can they afford the need of purchasing the home for their roof over their heads. And that's why we move on to the second article down here that we have that indicates that DBS reports that our GDP will raise to $1.4 trillion by the time we hit 2040. You may think that this is a very independent newspaper article, but actually it has got to do with the same precedents as what the Morgan Stanley article was all about before that. So here, let's go on to the TLDR of this article. So now, which brings us to our second article because the link happens here. So second article that that we are going to be talking about is the projected doubling of Singapore's GDP by 2040 could see Singapore dollars on par with US dollars, STI to hit 10,000. Okay, this is the same repeat of what we see in 2017 where we see Morgan Stanley say that wow, our Singapore property prices will double by 2030. Now it's already 2025, 5 more years to 2030. We already more than pretty much doubled already, because what used to cost 1 million for a 2-bedroom now costs about 1.7 mil to 1.8 mil for a 2-bedroom. We are close to that already. So drawing precedence from previous articles and research, we also must understand that Straits Times or whatever publishers do not anyhow publish news article without basis, and so we shouldn't just take them with a pinch of salt, but should really just take into our consideration whenever we are buying properties or entering the market today. So here we have the TLDR of this article. DBS forecasts Singapore's real GDP will grow 2.3% annually through 2040, leading to a doubling of the economy, reaching up to 1.4 trillion by that year. This long-term growth is projected to push the Singapore dollar to parity with the US dollar and potentially propel the Straits Times index to 10,000 points. Wow, wow, wow. So anyway, here are the key pointers of this GDP news. The first key pointer to start off is the long-term GDP projection. DBS forecasts the Singapore real GDP to grow at an average of 2.3% annually between 2025 and 2040. Economic doubling. By 2040, Singapore's GDP is projected to reach between 1.2 trillion and US 1.4 trillion, up from the 547 billion in 2024. The drivers of growth is mainly the expansion is expected to be driven by capital accumulation, human capital development and productivity gains. Productivity growth supported by infrastructure, talent development, digital adoption, and the green transition is expected to remain resilient and outpace the US over the past decade. Current impact. The forecast suggests that the Singapore dollar could trade 1-for-1 against the US dollar. Stock market projection, the Straits Times index, which crossed 4,000 points in 2025, could rise to nearly 10,000 by 2040 if historical return patterns hold. The market is currently supported by a strong Sing dollar, low domestic interest rates, and MAS initiatives to revitalize the market. Last but not least, the recent financial sector performance. The financial sector, which made up about 14% of Singapore's GDP in 2024, expanded by 6.8% year on year, more than twice the pace recorded the year before. So here's the TLDR of this entire article, the main pointers that you have to take note, but I'm going to draw this connection to real estate. As what we have seen before, I think linking from the population growth, your key question in your mind as a consumer is, can these people even afford the property prices or not? With the constant increase in property prices, the key question of affordability of this need, is it even possible? So I have another graph that I've shown before within my previous videos that I drew from UOB, and I really relate a lot to this. So first of all, we have to understand that the cooling measures are in place to keep income and housing prices aligned. They are definitely not here to drop prices, but they are here to maintain the rate of growth, meaning to say instead of such a steep gradient, they actually level it up a little bit to give it more time for the society as well as the economy to catch up, so that the property prices remain aligned with income to ensure affordability. So my key question to ask is always this: can the population growth really afford it? So here we have a graph here, which we see the blue line being the property prices, the red line being the nominal GDP. Now you see how the link is going to be coming in. And of course, I'm not here to debate with all the financial experts out there that, wow, GDP is this, is that, where got income component. I've actually done a little bit more research, and you can go and Google it yourself. When they go and assess GDP, that time there's actually 3 components that falls under the income aspect of things. So I think, of course, based on this, there will be quite a fair bit of exposure and weightage on the income portion within the GDP line itself. So anyway, the blue line is the property price, red line is GDP, which also means income representation in a way. So was there a time where it was actually cheap, right? There was a time where it was 300 PSF. Your grandmother's time, my grandmother's time, your mother's time, my mother's time, right? But why didn't they pour all their life savings in and buy real estate since it was so cheap back then, right? You will see that the blue line is actually above the red line. It also means that people cannot afford if they ever want to buy a house, or the general society has difficulties affording it. So meaning to say your parents can pour in their life savings into it, but whenever they want to liquidate it or want to take it out that time, nobody buy from them because the general society can't really afford it. Alright, so the fear is real. In a way, you can look at it in this way. It was cheap back then. but there was very little exit strategy. The fear is real. I pour my life savings in, but how easy is it for the society to be able to afford and take it over from me whenever I need money? Right? And this persisted all the way until 2004, where we see the red line and blue line coinciding and intercepting with each other. Now, finally, income in a way has caught up with the property prices. But because we didn't have cooling measures back then, it was very much susceptible to external global market factors. Whatever that is happening on the outside, anytime can hit Singapore, and Singapore will go through a lot of turbulence and fluctuation. We see in 2008, with that 2006, that's where the property boom actually happened. Alright, you can go and ask your parents or grandparents, they actually remember 2006 is a property boom. And of course, 2008 Lehman Brothers hit, and there were many fluctuations in the market. By then, the government introduced 14 rounds of cooling measure because they do not want such fluctuations in the market anymore. They want something that is buffered, something that is sustainable, something that will not affect the livelihoods of Singaporeans. And we see a difference by then. After 2014, remember, the red line is the income representation, the blue line is the property price. It did go through a little bit of adjustment and correction for our property prices, but for the greater good. Alright, so in a way, the government-induced policies have actually burst our own bubble 10 years ago already. And this is the one that creates the buffer and the graph that we see right now. Now, we have to understand what are the changes pre-2014 and post-2014. What changed in terms of government vision? Pre-2014, it was everything about investment. How to attract the best foreign companies into Singapore, how to attract the best foreign developers into Singapore, how to get the best foreign capital into Singapore to drive the GDP as well as the economics. But during that time, it also means that somebody must sacrifice, and that was Singaporeans. After 2014, the government vision changed. The government changed to everything Singaporeans first. Buy property as a need. What does need mean? Need means no matter how expensive it is, I will still buy as long as I can afford. And this is very evident in the red line as we see down here. The government has ensured robust income policies as well as cooling measures to ensure that our income continues to rise faster and wider as compared to the property prices. From such a narrow positive gap became such a wide positive gap. But by understanding this need concept, it actually helps you understand how to chart ahead in terms of Singapore property market. Alright, so if we look at here, buy property as a need, I'm going to talk about Norwood Grand. So Norwood Grand is the first OCR development that is so far out, kind of ulu in that sense for some people. No offense to Woodlands people, but for me, I never grew up in Woodlands before, so I forever be unfamiliar with that place. Remember, I talked about in my other videos familiarity, right? So each township has their own familiar population already that they are accustomed to. So if we take Woodlands for example, for many people, they say, what? 2000 PSF Norwood Grand launch, right? The thing is this, the need concept. I need to be near my parents' place, I need to be near my kids' school, I need to be near my workplace, I need. Alright lah, I see whether I can afford lah. Hey, I can then I buy lor. Alright, so in that sense, willing buyer, willing seller. CDL can actually price Norwood Grand at 2000 PSF, and people who need this, they buy it because they can afford it. That's why their prices hold lor. But if they were not able to afford it due to maybe economical policies or just really poor affordability, am I right to say they will not buy, and from there, CDL will not be able to hold their prices? Naturally, CDL will need to adjust. Understanding this need policy is very important in today's market. So coming back to this graph here today, it can be at 2500 PSF. It can continue to grow all the way to 3000 PSF. You will always have an exit as long as the government keeps up with its income policy and cooling measure policies, so that everybody will always be able to afford this need, indicating a clear exit strategy. Alright, so 3 years ago, there was supposed to be a crisis. I think everybody can guess what I will be saying, COVID. And if we look back at it, this is exactly where the dip is. COVID means what? Income must come down, GDP must come down. And it did. In fact, from this amplitude here, it came down by about 50%. But because of this buffer here and the need concept, I still need a roof over my head. I can afford. I buy lor. Do you see education is a need? Actually, education prices coming down during COVID? No, people could afford it. They pay for it lor. Commodities like pampers, diapers, it's a need. They still can afford. They pay lor. But because of this buffer in the market, it gives the government enough time to react while people are still being able to afford this need. And that's why at this point here, you will see economical stimulus happening. You will see income policies coming into play to stimulate the economy, to make sure Singaporeans can stay afloat. It gives time for the Singapore government to react so that people can continue to afford this need. Alright, fast forward to today. Actually, 1 year ago, there was actually a crisis. Here, you see the dip here? Why? The tech sector, retrenchment. Yeah, it's a sector that was being affected, but again, the general population, it is a need, I can afford, I still buy lor. Now, in the most recent times, there is a little bit of turbulence, a little bit. That's why the GDP came down a little bit, but because of this wide gap down here, it is safer and safer as we get to speak. So the clear picture to take note about this graph is this. Yes, prices may be high today, but although price is high, but also higher exit strategy as compared to before where it was cheap, but yet little exit strategy where people couldn't afford. Now we move on, drawing the connection to this latest article, which is the GDP that will be doubling by 2040. Alright, if 2024 GDP at 547 billion, prices continue to increase by 3.9% year on year, then what will happen in 2025 where our GDP rose to about 565 billion? What will happen to the prices? Now, if we double it from 2025 all the way to 2040, what will happen to the prices once the GDP increases to $1.4 trillion? Where do you think prices will go? With all the robust economical policies in place, I think actually Singapore property is a safe haven where you can really put into this so-called index, or if you consider property as a form of index, to be investing and keeping your capital safe and secure. Now finally, this is something that I actually drawing from the same graph that I always use to explain to my consumers. This is something new that I've done the projection. So according to the newspaper article, they say that it will double up by then. So I'm just going to use the same thing, the same gradient here, right? This is one exit, the next one will be doubling up. You can see based on this projection down here how wide it slowly becomes between the red line and blue line. As it continues to become wider, it becomes even safer for your exit strategy in terms of the real estate market. So the most important part is the buffering has already been done by the Singapore government cooling measure policies. In a way, buying property is a need. Once you have a need with the livability needs being met, you will always have a clear exit strategy as depicted down here. Finally, to consolidate everything together, all this news also boils down to the linkage to rental side of things. So this is a newspaper article on 20th of November 2025, very recent. Uncertainty over hiring, relocation clouds outlook for Singapore rentals after brisk Q3 by Savills. Of course, to begin to give you a quick TLDR of the article so that you don't have to spend too much time reading. So here are a few main pointers. In Q3 2025, leasing activity jumped. Private residential leasing volume increased by 24.2% in Q3 2025 compared to the previous quarter, hitting the highest quarterly volume in the past 4 years. Overall rent growth continues. The URA rental index for all non-landed private homes rose 1.1% in Q3 2025, marking the 5th straight quarter of growth. Year to date, rents are up 2.4%. Of course, if we look before that, you will realize that actually the rents corrected by about 8 to 10% post-COVID period. So contrasting segments, rents rose in the suburban OCR by 2.5% and the city fringe RCR by 1.8%. However, the prime core central region CCR saw rents decline by 0.5%. High-end rental growth also slowed, notably to 0.7% in Q3. There is a hidden weakness. The strong Q3 volume, which typically peaks due to seasonal expatriate and international student influxes, may be masking hidden weaknesses because EP numbers are contracting due to tightened policies and higher qualifying salaries. So this pointer itself actually ties in with the first newspaper article that we were mentioning just now, that the population of foreigners is actually contributed by work permits and as well as domestic workers that help to build the housing expansion as well as infrastructure programs like the Changi Terminal, rather but not the expatriates that are holding EPs. In fact, they are contracting due to tighter and stricter policies. So in a way, for those that are seeing that foreigners are growing, then you can say that I can draw a better yield because the demand is going to be higher. Think again, because in fact it is contracting as what the newspaper article says. So for homeowners down there that are always thinking about getting a better rent, actually you have already gotten the better end of the stick. Your rentals have increased more than 20 to 30% post-COVID. It did go through a little bit of correction of about 8 to 10% year on year, but the key thing is this: you are already getting it better than what we were getting before COVID. So be contented, take in the rental so that you can sustain your mortgage. But the key thing is this: the key focus of Singapore real estate, it is also on the focus of capital appreciation. Now you may say that, hey Matt, you're being very speculative on it. No, of course data and trends, we have already gone through it. We have seen how I've analyzed the GDP versus the property prices, so on and so forth. But the key thing is this: the government vision focus of buying a property is buy based on because you need it. When you need it, it also means what? It also means that you will buy as long as you can afford it. It also means the natural need is there equals to natural demand. It is also because there is natural demand, that's why you will have an exit strategy, and that's why you need to know how to play the game, which is capital appreciation. If you actually count for rental, I always call it a zero-sum game. Why? Because if you count the maintenance fee, the interest rates, the higher non-owner occupied property tax, the income tax, the agent commission, the maintenance of the unit, actually it all boils down to maybe only about a net cash flow of extra 10 to 20k per annum. Is renting really that good? But of course, by renting, you have this other concept of other people's money, OPM, that will actually pay off your mortgage together with the principal along the way. Just by holding it, by the time you hit 65, you would have already that full capital value sitting there waiting for you. But of course, if you are able to capitalize on capital appreciation and you understand the property market game in Singapore, then naturally, why not we head towards that direction? Because the natural demand is already so high. Finally, with the TLDR impact on high end, the decline in EP numbers and reduced housing allowance may reflect a shrinking pool of senior level expatriates professionals, evidenced by a 7.6% year-on-year drop in leasing for landed homes in Q3. Alright, supply expanded significantly with 1,776 new private homes completed in Q3. Despite this new supply, the overall occupancy rate ticked up slightly to 93.1%. For the final outlook, the road ahead is clouded by business uncertainty, and the pace of leasing activity is expected to moderate as companies may reduce operating costs. Forecasts of rents for 2025 are cautious, ranging from remaining flat to growing 1 to 3% over the year. So anyway, if you just look at the article, I want to draw your attention to these two graphs. This graph itself is already an evidence illustrating that the number of employment pass holders from December 2020 to June 2025. After December 2023, you see a slight decline from 210,000 EPs down towards the 200k mark. So meaning to say 10,000 expatriates that are holding EPs would have been already gone home or relocated back home already. And of course, this is the rental prices of a slower growth, Saville's high-end non-landed residential rental index. You would see that it did decline from the year 2023 all the way to mid-2024 and finally experiencing a slight recovery. As what I've mentioned before, based on this graph here, you will see that actually post-COVID you have gained at least close to 30 to 40%. Of course, it corrected by about 10%, and finally now you have gained back the extra 3 to 5% recovery. So whoever that you're renting out, actually you are already in line with your installments and housing mortgages. With the interest rate actually coming down, definitely with this such a good rental coming in, it will actually increase your yield but also better affordability of your mortgage. Alright, so now since we have covered the three news articles that we wanted to focus on today, to sum it up, number one is the population growth that represents the ever-growing demand in the Singapore property market. The second newspaper article actually highlights the affordability of the need, and that was why I wanted to bring forward to you. And finally, the third article, which is rental, which also sustains the mortgage in times where you feel that maybe it's a bit tighter on the pockets or what. Naturally, Singapore's rental market is also very sustainable due to our need of foreigners to help drive the economy as well, which is the expatriates. But of course, they are all linked together because we can see the population allocation based on the Singapore government. They are allocating more of the passes to the work permit holders as well as domestic help workers or construction workers to help build certain projects in Singapore. So they toggle up and down. So with all these things linked, where are we in the market right now? So I think key thing that you want to be focusing on is we are reaching the end of the changing policy. What am I talking about? Which is the GFA harmonization policy. So if you look back when this policy was actually implemented in mid of 2022, everybody was confused by this GFA harmonization. Actually give you a quick summary, it is the removal of the AC latch within the unit layout floor plan. Alright, and with that in mind, that's the simple layman's term of explaining. Another more in-depth explanation is also the measurements by SCDF, BCA and URA must start measuring the dimensions from the middle of the wall to the other side, the middle of the wall. Alright, so indicating that there will not be any discrepancies in terms of measurements. This also dictates and controls how developers build their units, because in the past, depending on how they submit their dimension and measurements, right, they can count from one end to the wall to another end of the wall. Some count from the middle of the wall to the middle of the wall. Some count from the internal side of the wall to the internal side of the wall. If you understand what I mean, yeah, you understand. So that's why sometimes you go and walk into a resale, they tell you it's 9 square meter, but somehow the 9 square meter didn't seem so big. You go into another development, they tell you it's 9 square meter, but somehow the 9 square meter seems so large. So to prevent any more discrepancies like that will affect livability, government decides to universalize everything. Everybody come from middle of the wall to middle of the wall so that there will never be any misrepresentation or miscalculation of how the dimensions of the bedroom should be calculated, and there will not be any discrepancies in terms of the livability of the unit. So with that in mind, this policy change itself actually resulted in a little bit of uncertainty in the market and also drawing in lower land bids as the developers were a little bit more cautious. But of course, the government was very prudent as well as careful. They do not want to cause any instability in the market. How can a newer land launch be sold cheaper than the previous land that launched in the same area? So that's why they had certain calculations that they have made, and they would then approve certain land sales. Alright, so if we look at back then like Tembusu Grand versus Admiral at Katong, ultimately Admiral at Katong did launch higher or at least the same price at Tembusu Grand, despite the land price being cheaper than Tembusu Grand's land price. All the calculations has already been factored in because of the GFA harmonization, because of the different distribution of space and GFA. Government is confident that the developer has to launch higher than what was sold before, and that itself is safe enough not to cause any instability in terms of prices as well as the market. But that itself is already coming to an end. Why do I say this? Is also because we see that the recent land prices are starting to normalize and regularize again. By right, land prices are supposed to go higher and higher, not cheaper and cheaper. Like that, nobody dare to buy property anymore, because the longer I wait, the cheaper it goes. Doesn't work that way. So naturally, government had already a fail-safe and calculation prudency already factored in when they did the GFA harmonization, and that's why they dare to sell the lands to developer. Back then, they even dare to reject land sales. If you recall, beside the One Marina Gardens, there was a land that was actually bidded by another developer. It was cheaper than the previous land sold, which is now One Marina Gardens. In the end, the government rejected the bid because they know it will cause instability within the area. So coming back, why I say land is regularizing and normalizing is because we see land prices in Little India, for example, is more expensive than what we have in the city area. The most recent news, which was in October 9, 2025, UOL Group, Singapore Land Group, King Leong, top 9 bids for Dorset Road GLS site with 1338 per square foot per plot ratio offer. And with that in mind, this is actually the map where we see Dorset Road is actually in a very nice location along Racecourse Road or Owen Road. This is where Little India is. And if we look at it, this is an RCR development being more expensive than Zion Grand 1250 per square foot per plot ratio. It is even more expensive than the River Green land price of 1320 per square foot per plot ratio, and same goes for Promenade Peak itself as well. So with that in mind, it is also an indicator that the land prices are normalizing and we are reaching the end of the GFA harmonization effects. So for those who are still sitting on the fence with the consolidation of all these newspaper articles, maybe you might want to take a closer look on the current launches that is already available in the market, such as Alta, such as Nava Grove, such as Bloomsbury, where they belong to the first batch of harmonized developments that came out in 2025. Alright, and of course after 2024 mid, because Lentor Mansion was the first ever new launch that is harmonized in the entire Singapore. They were launched in 2024. And so with that in mind, you may really want to consider the existing batch of new launch, because you will still be in an advantageous position as you are going into projects that came out at the start of the changing policy of the GFA harmonization. Their current sales price may still well be cheaper than the future new developments that are going to be coming out due to the higher land price and the normalizing of land prices as they head towards the end of the GFA harmonization effects and policies. So with that in mind, I hope I've managed to clear some of your market barriers, but most importantly, how to choose your development and how to choose your unit that caters to your scenario. Sometimes we may not be able to find the perfect property at this current moment due to constraints such as budget, such as needs, such as space, etc, etc. But can we actually use this current batch of advantage position as a stepping stone to get your dream home in future? Alright, so with that in mind, do reach out to me for a one-to-one consultation, as I have the answer to all of your scenario with my 16 years of experience. How do we chart ahead? How do we make sense of the current market obstacles or current scenario obstacles and turn it into an advantage for you so that we achieve your final big picture objective or dream home? So remember to like, share and subscribe as we continue to work hard to create more insightful content for you. Contact me at 94569398 for your one-to-one consultation. So with that, we end today's episode. See you in the next one.